First up, the way the markets moved today, it was a day where we opened lower, then saw a bit of a recovery. That recovery was sold into. All of that while Reliance was putting pressure on the index on one end. It was the last street's longest winning streak since October that came to an end as bulls took a breather. The Sensex as well as the Nifty lost about 0.5% each. The Nifty, however, closing above that 16,600 mark. The auto stocks along with Reliance also weighed in on the market, some profit taking seen out there. Anuj Singhal joins in with the wrap of all the action on D Street.
Well, the market was down but not out. I mean, let's put it that way. When the first hour started, it looked like it could be an ugly one. But then towards the end, there was a recovery, which also got sold into a little bit. So all over the place. But really, the market had a lot to negotiate with today. And the biggest drag was Reliance. That really accounted for 2/3 of Nifty's losses. Financials, of course, managed to outperform once again. But as I said, the drag on Nifty was mainly because of Reliance. In terms of other stocks, you had the auto names which didn't do too well. So M&M, Maruti and Eicher were down. Kotak, of course, didn't participate in the financials rally because of its own numbers. And the two life insurance stocks, SBI Life and HDFC Life, which have been underperforming, continue to underperform even today as well. Among gainers, you had a lot of stocks rallying ahead of numbers. Tata Steel, for example, Larsen and Tubro, and of course, IndusInd Bank has been getting itself into a good groove. That continued to do well. A stock of the day today, though, on the downside was Zomato because of large volumes, and the stock sold off 10% as the lock-in for pre-IPO investors ended. And a couple of chemical stocks did well, SRF and Navin Fluorine. Overall, this is a market which has still been in an uptrend. It will be interesting to see if today marks a reversal of that or was just a flash in the pan. We'll find out, of course, soon enough.
We will find out, and there are a lot of triggers for that as well. Apart from the corporate earnings here, we do have a lot of earnings in the US as well as the Fed meet outcome. For all of that, we will monitor the market situation. And until then, let's hear out some market opinion coming in from Dheeraj Agarwal of Ambit Capital. He says that he continues to remain bullish on select banks despite a mixed set of earnings coming in the banking sector. He does expect some further downside for the IT companies as margins could be under pressure. Listen in.
Earnings have been mixed so far, but by and large, there have been a few bright spots. For example, in banking, we have seen earnings by and large have been quite decent, and which is what we've been expecting. So far, I would say the earnings season has been reasonably decent. But as usual, it's a little bit of a mixed bag. And overall, going forward, I think the trend of earnings cut will continue as the demand will disappoint a little bit going forward because of high inflation. We see more upside in ICICI Bank. It's a top pick in the banking sector, along with SBI. Tech has been seeing continuous correction for quite a few months now, although we see more downside. On the margins front, we think there is probably a little bit more downside at this point of time. There will be pressure either on top line or on margins or on both. So we still believe that the IT valuations have not reached a normalized kind of a level considering a normalized growth outlook and margin outlook going forward. So we still see more downside.
All right, let's get in some more market opinions. Suresh Tantia, who's a senior investment strategist at Credit Suisse, also said that the equity market will not react negatively to the Fed rate outcome unless there's 100 basis points rate hike by the US Fed, which is something that not a lot are actually anticipating. He said that the Indian market does not look very exciting at the moment, though, currently because of high valuations.
I think markets are already sort of pricing in the 75 basis point of rate hike from Fed in this meeting. And going into the earnings season as well, the expectations are very low. Positioning is also very low. So I think it's unlikely that we will see a negative surprise, especially from Fed, because what we have seen over the last 6 meetings is that equity market have reacted 5 out of 6 times. So unless there is a 100 basis point of rate hike from Fed in this meeting, I don't think equity market will react negatively. Overall, on the market, I think you might see some profit booking taking place. And at broader level, when you look at India in the context of Asia or the global markets, it doesn't look very exciting because of the high valuation. You have cheaper alternatives, especially in China equity market, which is trading at such a low valuation, or even in the developed market space, US market is now trading below the valuation of India. So I would stick to US and China at the moment. But having said that, I don't see we're going to see a large downside in Indian equity market.
Right. The other thing that stood out today in terms of macros was rupee. After a week of losing ground against the US dollar, it's appreciated 9 paise to about 79 rupees 73 paise to the dollar. This after it remained in a tight range for most of today's trading session. It ended at the high point of trade, and Lata joins in with the details of that. Lata, what is it that caused this sudden show of strength from the rupee? How sustainable is this? Is this purely on the back of RBI's dollar selling and the crude prices declining?
Strongest point since a week, since July 18th, closing at 79.73. Several things helping, but the biggest of them all was really crude prices now moving decisively towards the $102, $103 mark. That is the spot price. If you looked at the October futures, they are even below 100 at 98. So the market is clearly pricing that in. But equally important, the Reserve Bank intervention. The numbers are out on Friday evening. And last week was a solid $7 billion. It was a $7 billion intervention. Before that, market coming to terms that the Reserve Bank is going to put up a fight probably around the 80 rupees to the dollar mark, and therefore exporters probably have started selling. In any case, exporters usually sell dollars in the last week of any month, since they have to just book a part of their earnings. And finally, we saw the dollar also weakening. So towards afternoon trades, the dollar the dollar index, that is, weakened decisively from about 106.7 to 106.2, 106.3, and therefore you saw all emerging market currencies rising. It's quite possible that even in the Indian NDF market, the non-deliverable forwards market, the rupee market up offshore, people have started probably, buying back dollars. The long dollars frenzy is probably coming down because the FOMC meeting is there, and therefore people don't want to go with positions into that meeting.
Take that point, Lata. Thanks a lot for that. With that, let's move on to the second headline now. Shares of Reliance Industries were the top contributor on the downside to the Nifty, fell 3% as the profits missed brokerage estimates following a higher than expected tax and depreciation. The fall came despite a record quarterly performance across verticals for Reliance Industries in the first quarter. Sonia Shenoy standing by with all the details.
Well, thanks a lot for that. Reliance Industries ended in the red after it reported numbers that were below street estimates on the profitability because of higher tax as well as higher depreciation. Brokerages across the board have a target price of anywhere between 2,500 all the way to 3,250, with Morgan Stanley being the most aggressive, having an overweight with a target price of 3,253 on the stock. Now, Jefferies put out a note where they said that the company missed street estimates by 1% on the EBITDA front because of weaker than expected refining business, and the margins disappointed on account of higher network operating costs. The profits were also lower than estimated because of higher tax and higher depreciation. Credit Suisse said the next event for the stock is the annual general meeting, where they expect more disclosures on the new energy and services business. Macquarie said it was a solid operational performance boosted by the refining margins and the gas price, while JP Morgan put out a note where they said that the strong operating EBITDA across businesses is what has aided the profitability this time around. The O2C business has led the way from the front. So mixed bag coming in. Profits, of course, were below street estimates, and hence the stock was under pressure today.
All right, and some expert opinion on Reliance itself. We got Jal Irani of Edelweiss Financial Services, who believes that the near-term fundamentals of Reliance do remain subdued because of the windfall tax. Meanwhile, Balaji Subramanian of IIFL Securities said that the improvement in subscriber addition for Jio is definitely a positive sign.
Its most significant driver, which is GRMs, have gone from $30 to near zero within a span of 3 to 4 weeks. And yet you've got a huge windfall tax of $4 a barrel. So that windfall tax has to go, because not only is it impacting earnings dramatically, and there is no windfall anymore. I think as a combination of that, the near term unfortunately doesn't look very good.
The good thing was that we saw the net subscriber additions coming back into the black of close to 9 to 10 million after seeing multiple quarters of decline. That I think is explained by the fact that Jio is largely done with its subscriber cleanup exercise, and some of the SIM consolidation that we saw post the tariff hikes, that has also moderated. Going forward, I think it will be a combination of a slight improvement in subscriber additions, while until the next round of tariff hikes, we are probably going to see a very mildly increasing ARPU trajectory for Jio.
The third headline today, we had high supply pressure coupled with wage hikes that have taken a toll on the margins of the IT big boys. TCS, Infosys, HCL Tech and Wipro have all reported a miss on the margins front. Reema Tendulkar gets us the key takeaways from the big four of the IT companies' Q1 earnings.
So the big headline is that there have been margin misses across the board. The second headline is the deal wins, which is seen as a lead indicator for future growth, have also been fairly tepid. That said, the revenue growth this quarter continues to be very strong. The guidance by the companies was healthy and encouraging. We had Infosys raising their revenue guidance as well. The headline number 4 is that BFSI momentum appears to be softening. And finally, the mid-cap IT companies have fared better than the large cap. Well, these are the top takeaways, but let's dive into each of them in greater detail. So first, on the point on margins. While margins missed the mark across for all the IT companies, led by high supply pressure, wage hikes for companies like TCS and Infosys, rising subcontracting costs, and the reversal of travel facilities. Take a look at the picture. For companies like Infy and Wipro, margins are at record low. For HCL Tech, it's a 10-year low. For TCS, it's a 14-year low. And for all the 4 IT companies, the decline in margins on a quarter-on-quarter basis is between 100 to 200 basis points. The sharpest decline has come in by Wipro, a decline of 200 basis points, and this is despite there having been no wage hike this time around. Let's move on now to the second big takeaway, and that is deal wins. Now remember, deal wins are seen as a proxy for future growth, but they were also fairly subdued, particularly for heavyweights like Infosys and TCS. The deal wins this quarter were disappointing. Let's focus on Infosys because that's the one which came out with their results last. The Q1 deal wins are the lowest since Q1 of FY21, a year ago. Even if we look at a 12-month period to iron out the volatility which typically happens in deal wins for Infosys on a trailing 12-month basis stood at $8.6 billion, which is down 43% compared to the 12 months ending June of 2021. For TCS, in the current quarter, deal wins were down 27% quarter-on-quarter, just up 1% year-on-year, and this is the picture on a trailing 12 months basis. The third takeaway is on the top line. While the revenue performance was fairly in line, there were no negative surprises. In fact, Infosys managed to report a beat this quarter. They had the highest revenue growth of 5.5% in the large cap pack, and the outlook is still very promising despite the deteriorating macros. Infosys raised the FY23 revenue guidance to 14 to 16%, while Wipro, which gives you a quarterly guidance, said the Q2 growth will be between 3 to 5%, very healthy. Also, the management highlights that the CEO-COO discussion suggests that the clients are watching the macros, but there has been no impact on business yet, no project cancellation, no deferment of technology spends as well. The fourth takeaway is looking at the internals. The BFSI growth is a bit softer compared to the company's average growth in the quarter, especially for TCS as well as Infosys. Even Emphasis spoke about how the mortgage business, which is a part of the BFSI vertical, gets impacted by rising interest rates, and that's going to be a trend the street will watch very closely. And finally, we've been talking about the large caps, but this quarter, the mid-cap IT companies have performed better than the large caps. Mindtree, L&T Infotech, Emphasis, all of them reported margin beat compared to consensus expectations. And look at numbers. Take a look at Persistence revenue growth. For instance, revenue growth has come in at 11% on a quarter-on-quarter basis ahead of consensus expectations. And even on an organic basis, the revenue growth was at 5.5%. But the question is really on margins, where the picture for mid-cap IT has been resilient. But can mid-cap IT be immune to margin pressures when the large-cap IT companies have been a hit? And that's going to be a trend that we will watch in the subsequent quarters. Right now, it's back to you.
All right, Reema, thanks a lot for that. With that, it's time now for a short break. We'll be back in a jiffy with all the other headlines. Come back here, still with us here on Markets Today. Let's talk about the rest of the headlines that we're tracking for you. And mind you, there are a few as well. The fourth headline, the bank performances in, our markets were in the spotlight today with the key sectors, major companies reporting their quarterly numbers, we had ICICI Bank delivering a stellar performance with record growth and margins, while Kotak Mahindra Bank too followed suit, reporting margin improvement. However, the profits were below street expectations for Kotak Mahindra Bank. Axis Bank also reported a strong performance for the quarter, beating expectations after posting a rise in their net interest income. Abhishek Kothari joins us with a wrap on all the bank's performances.
Well, to begin with Axis Bank, it's a mixed set of numbers coming in from Axis Bank, wherein, the strong side is seen in the P&L. However, business momentum or the balance sheet momentum remains weak. So in terms of net interest margin, it's come in at 20-quarter high of 3.6%. Now, CLSA was estimating, net interest margin to be at 3.5%. So they have reported NII of 9,384 crores, which is higher than our poll of 9,150 crores. They have reported profits of 4,125 crores, while we were working with a number of around 3,600 crores. The beat on PAT is also on the fact that provisions are very low. Provisions have declined by almost 63.5% sequentially to about 359 crore. In terms of business momentum being weak, quarter on quarter, the loan growth has, or the loan book has declined by 0.9%, which is an 8-quarter week in terms of loan growth. Deposits have also declined by 2.2%, and even the CASA ratio, which is at 4-quarter low of 43.7%. Talking about asset quality, slippages remain elevated at about 3,684 crores with an annualized slippage ratio of 2.1%. This is down 7.5% quarter on quarter, but remains on the elevated side. However, gross NPA and net NPA ratios both have improved. Back to you.
All right, Abhishek, thanks a lot for that. Sticking with the banking space itself, we caught up with Chandrasekhar Ghosh, who's the Bandhan Bank head, and we also had Sandeep Batra of ICICI Bank to find out their take on their bank's quarterly performances. Listen in.
My portfolio is a stress, whatever has come, it has come from the restructure amount, which I already provisioned, and it has come to this, the SMA 2 and 1. But if you go to this, my NPA, that is, has come less than 2%, my credit cost 2.7%, which is I expected, and we are also feel that it is like to future in this financial year again come down on these two things.
Current quarter, there were net additions to gross NPAs of rupees 382 crores compared to a net deletion of 489 crores in Q4 2022. Recoveries and upgrades of NPAs, excluding write-offs and sale, were rupees 5,443 crores in Q1 2023. But the gross NPAs written off were rupees 1,126 crores in Q1 2023. The bank sold gross NPAs amounting to 13 crores in Q1 2023 on a cash basis. Total fund-based outstanding to all borrowers under resolution as per various accident regulations declined to rupees 7,376 crores.
All right, with that, we will talk about JSW Steel, which posted an all-round weak set of first quarter earnings, missing estimates on the revenue and margin front. Nigel joins in with a wrap of all the numbers. Nigel.
Well, that's right. JSW Steel's numbers were a bit of a disappointment. There's a miss on the top line. There was a bigger miss actually on the EBITDA front as well as the margins. Well, what was the miss? It was primarily because the standalone EBITDA per ton, that saw a sharp contraction coming in at around 8,300 rupees per ton. We were working with a number that was a little higher than that. Well, the management had some clarification with regard to this 8,300 rupees odd. They believe it will be relatively higher. Well, the next quarter, though, is likely to be softish, so we'll have to see how that plays out. But besides that, even their Indian subsidiaries, whether you look at the coated steel business, that reported an EBITDA loss this time around. Even the acquired Bhushan Power and Steel, well, the profitability out there did halve, coming in at around 700 crores or thereabouts. The other problem was that the debt number went up by close to 10,000 crores. A few factors played out here as well. Inventory did build up, and also because of the forex fluctuation, well, they got hit on that account as well. Management believes, though, some part of this will reverse in the coming quarters. Jefferies, they expect margins to remain weak. They say, yes, input costs have cooled off, but the problem is steel prices as well have cooled off, a little more than that. So that's why they're maintaining their cautious stance. Back to you.
All right, Nigel, thanks a lot for that. On to the fifth headline for today, and perhaps the stock of the day was Zomato's shares dropped 11% to hit an all-time low as this one-year lock-in period for their pre-IPO investors ended, and the stock is now down 72% from its all-time high of 169 rupees, with nearly 1 lakh crore rupees in investor wealth being wiped out. What exactly took place? Well, 37% down from its issue price of 76 odd rupees, and with huge volumes today, nearly 5.5 times 10-day average, and that as 78% of the company's equity holders, or the number of shares that are outstanding, are now eligible for sale without disclosures as the one-year lock-in ends. 78% of pre-IPO investors, which include the founders, the promoters, at the same time employees, as well as some institutions. And as we speak, as of data just before market close, we had nearly 10 crore shares marked for delivery as of 3 p.m. on both the exchanges, and that's telling you that there is some serious supply pressure as well. The stock, from its market cap of 1.34 lakh crore at the peak, has now reduced to 37,400 crores in terms of its market value, and that's an over 1 lakh crore rupee erosion of its wealth. The biggest reason for that is the management's non-committal timeline for profitability. They say that they are going to be profitable, but when is the big question. Two shareholders, Uber as well as Delivery Hero, hold about 10% stake in the company. So important to see what they do with these shares as well, because for Uber, something like this would perhaps be non-core. So are they looking to sell or not is the big question. But sticking with this business itself, sources tell CNBC-TV18 that in light of the tepid demand, sales of block shares are likely to be undertaken in tranches. Nisha Poddar joins in with more details on the CNBC-TV18 exclusive. Nisha, take us away.
That's right. Zomato is a stock in focus, and with the lock-in period for the pre-IPO investors now ending, sources with direct knowledge have shared with us that there could be several tranches of the sell-off over a period of time and not in one go, and that could really sustain the selling pressure on this particular counter as well. Remember, it's also dependent on the demand for this particular paper in the market. There should be buyers, ready buyers, and at what price also will depend the future sell-off by these investors. But one important aspect to note here is that some of the large investors with both position in Zomato are also categorized as insiders, and their selling can only happen after the silent period is over, which is after 2 days of their result announcement in the month of August. So that will be an important timeline to watch out for as well, whether Alibaba Group investment firms are going to come up with a big tranche. So that's the next event to watch. In my view, as per sources with direct knowledge, InfoEdge, the largest shareholder, is not a seller at this point. Now, to arrest the fall and allay the concerns for the investors because of the constant supply of paper that is imminent in Zomato, Zomato management is likely to hold roadshows for the investors right after the results are announced, and that could be to allay the fears in the minds of the investors. But for some time now, Zomato stock will be in focus.
All right, we will watch that. With that, it's a wrap on this edition of Markets Today. Stay tuned to CNBC TV18.